Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are talking metals and gold prices. Well, they've seen better days. You go back the last 2 days, we've seen gold decline over 20 bucks. It started on Friday, continued on Monday, and you've kind of fed off the aluminum selling. Recall that the news that the U.S. may modify their sanctions to Russia, give them more time to kind of reorganize, and that sent aluminum prices. So it's maybe a sympathy sell-off, but that's not the only reason. We've been in this 1330 to 1350-ish range in gold. We tested the upside several times. We came back into that range. It just seemed like the market was going to be weighing on prices moving higher based on the risks in the market, based on what you're seeing in the Middle East, whether it's North Korea. It all had this hype of fear built into it, and now things aren't so fearful. And today and on Friday, we saw gold prices decline significantly. Now we're outside of that range, which means we go from being, neutral bullish to neutral to bearish very quickly. And I think that right now, if you're looking to get short, I'd probably wait and see if there's any confirmation. But I think a lot of longs have been exiting on this push down. And you look at spec longs; they were buyers up, adding to positions early last week. We saw the CFTC reports, but I think middle of last week into today, you're seeing them push this market lower, and they're probably going to be net flat at this point, looking to get back in and waiting for some kind of a bounce, waiting for some kind of a sign, because right now the market seems to feel like it's in kind of a free fall, and we've broken through some key significant support levels. Let's wait and see when the dust settles. They may come in and sell it with the idea that there's more selling to come, but at this point I think it's very unclear. And one other reason why we're seeing gold prices decline so rapidly, I think, it has to do with treasuries. And you look at treasury yields rising up to 3%, possibly looking for a breakout move to higher yields there. Let's not forget that while they're both flight to quality instruments, the 10-year has a yield of 3% and gold has a yield of, 0. And I think that is also taking away some of the attractiveness of gold from investors. Like, hey, let's move into treasuries where we can get a handsome yield, one we haven't seen in 4 years, as opposed to gold where we have to kind of wait for price appreciation or some kind of event to push it around. So right now, I think not only is it about the commodity bucket seeing their best run, seeing maybe a little bit of a sympathy sell-off. We've got technical reasons why the gold's going down. We've got a strong dollar, and now you got treasuries touching 3%. There's a lot of reasons not to own gold here. I'm not necessarily want to be short gold, but I think at this point, I'd wait and see where the dust settles, because any given event, any given time, you can see gold rally. But right now, the fundamentals and the technicals are telling you, take your hands off. Let's wait and see what happens when the dust settles. So gold breaking out of the range, the 1330 to 1350 range, possibly eyeing 1300. We're not there yet. Let's wait and see what happens. This is Todd Colvin coming to you from the floor of the CME Group.